This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Anyway, let's move on to page 87, Prospective Financial Information. This is another assurance service type of thing, like review engagements, agreed upon procedures, assurance service about a particular matter, a test engagement which we looked at this morning. This is another one, Prospective Financial Information. You could virtually write this chapter out for yourself, because we've now gone through, we've looked at review assignments, we've looked at agreed upon procedure assignments, we've looked at test engagements, and all the same things will be applicable. I can virtually guarantee there will be something in this chapter about engagement letters. There'll be something about documentation. There'll be something about the form and content of the report. But there are some audit steps in there as well, or there's a question about audit steps in there as well. Yeah, on the next page. So let's just very quickly then fly through 87. Prospective financial information means information which is based on assumptions about events that have not yet happened. Events in the future which may occur, and possibly the action then taken by the company. Listed companies should have procedures allowing them to generate reliable PFI, to compare it to market expectations and publish it when necessary. Should there be, or is there an argument that says that companies should publish within their financial statements, they should publish their forecast for the next year? Is there any argument? Because one of the drawbacks of statutory audits and the publication of financial statements is that they're all historic, and by the time you're getting them, Devro was the 12th of March, that was signed by the directors and the auditors. By the time the 12th of March comes along, you're already 10 weeks into the new year. And so the financial statements are telling you what the position was 10 weeks ago and what the results are for the previous 62 down to 50, down to 10 weeks. So the 52-week period starting 62 weeks ago. And it's history. It's gone. There's nothing we can do to change it. It's simply reporting on the stewardship by the directors of the company's assets and how well they have performed. And it's meaningful, and it tells you about their corporate social responsibility and how they comply with corporate governance requirements and the number of injuries per million hours worked. It tells you all of that information, but it doesn't tell you anything about the future. There is an element within there about where they're hoping to be in the next year and how their key performance indicators are heading towards the targets that they set for 2015. But other than that, there's no indication of any potential problems that they've foreseen in the future. There's nothing to say this is where we intend to be financially at the end of December 2012. So there's nothing in there about the future. And there is a current discussion, movement or school of thought, which says there ought to be, for instance, cash projections, cash flow projections, should be published within the published financial statements. And they should be audited. Now, I'm happy personally with the idea that cash projections should be shown, including last year's cash projection compared with, or profit forecast compared with actuality, to show how well our projections, how close our projections were to actual performance. I'm happy that that should be shown, but I don't see how you can audit it. How can you audit it? How can you reach an opinion on truth and fairness about something which has not happened? Surely one of the advantages of an audit is that we're relying upon, one of the advantages is that we're relying upon historical fact. Whereas, by definition, prospective financial information is wet your finger and see which way the wind is blowing. And I don't see how that can be audited. But that's a personal opinion. What do you think? Can we audit it? It seems that general consensus is apathetic, or no, we can't audit it. I've got one or two shaking heads, but nobody nodding. No. So by definition, by common sense, you should be able to work out the form of the report that an accountant stroke auditor is likely to issue when asked to review prospective financial information. What will be the nature of the wording of the accountant's report when they are asked to review prospective financial information? Are we going to get an opinion? Or are we going to get a reported conclusion? Are we going to get positive assurance or negative assurance? Are we going to get high level or moderate assurance? Common sense will tell you. Let's ask common sense, what do you think? By definition, it is not available to an accountant, a reporting accountant, to express an opinion on the accuracy or reliability of a prospective financial information cash projection. It's just not possible. Or profit projection. It's just not possible. Because there are too many uncertainties. It's not too many uncertainties, it's every uncertainty. Even something as concrete as the value of share capital in a projected balance sheet. You don't know. The company may issue more shares. It may not be their intention today, but it may be their intention in 4 months' time. You don't know whether the company may buy back some shares. You just no idea, and therefore it's not available to an accountant, reporting accountant or auditor to express any sort of opinion. All it can do is say that prospective financial information appears to be accurately prepared in line with the assumptions stated. Matters to consider before accepting an engagement to report on prospective financial information. Again, common sense will tell you. What is it being used for? Is it for internal or external? If it's for internal use, it's not a problem. It really isn't a problem. You can prepare whatever you want and be as optimistic as you want or pessimistic as you want. If it's for internal use, clearly the closer it is to reality and commercial reality, the better, but it doesn't matter if it's for internal use. But if it's for external, if you're showing a bank in order that they continue lending, or you're showing a bank in order that you could in the future borrow money to undertake a project, then it becomes important. Whether the information is going to be for general or limited distribution. Again, limited distribution, and you can work out what the wording of the report is going to be. This report has been prepared for the sole use of, and name them. If it should come into the hands of anybody else, it shall not be used for any purpose, without our prior written permission. The nature of the assumptions on which the information is based. And you will find that people, when preparing cash forecasts or prospective financial information, they will make the assumptions which are necessary to generate the result that they want to show. I am so cynical about this, but I don't really want to use the word cynical. I think I'm being realistic. That you're not going to prepare prospective financial information which shows a situation that you don't want to publish. You will only prepare it with the result that it does show, the result that you wanted to achieve. The information which is to be included, how deep and how detailed is the information that you're going to get into. And the period covered by the information, the shorter the period, the more reasonable it is that we're likely to achieve the results predicted. The longer the period, a 5-year projection, oh my Lord, where are you going to be in 5 years' time? Think 5 years ago, any of you, think 5 years ago, did you imagine that you would be married or single or divorced? Would you imagine that you had children to look after, or that you would be working at the employer 5 years ago? Was that in your mind that you would be? Was that in your mind then that you would be where you are now? Yeah, you think so? Where are you going to be in the next 5 years? Predict now, and I'll see you in 5 years' time. Not doing a retake of P7, I hope, but I'll see you in 5 years' time. Where am I going to be in 5 years' time? Somewhere sunny, I hope. Somewhere with a bit of sunshine and not facing 7 months worth of winter with icebergs drifting past on the river. You can't predict. You can't know today. You can't know which of your relatives are still going to be alive or which new relatives you're going to have. You can't predict that. So the period covered by the information, the further into the future the prediction goes, the less reliable and less able you are to pass any comment on it. When you're making the examination, this is the examination of the prospective financial information. This is not the examination that you're facing in 10 weeks' time. This is when you're examining prospective financial information. The audit firm, I hesitate to use the audit firm, the engaged accountant should obtain sufficient appropriate evidence as to whether the assumptions are not unreasonable. As long as they're not unreasonable, I suppose that's the same as you have to determine that the assumptions used are reasonable. And the classic exam question, P7 exam question, the person making the projection had assumed a 20% increase in sale price and a 5% growth in sale volume. And you're thinking, well, is that likely? If I increase my selling price by 20%, am I also likely to get a volume growth of 5%? And instantly, and the examiners, all the examiners are very kind and gentle people in their own right, they will make it obvious that these assumptions, or that particular assumption, was totally unreasonable. It's not going to happen. And we were going to start taking 90 days credit from our suppliers and still expect a 10% discount on the cost that we had to pay. And again, it's totally unreasonable. So the assumptions that will be given to you will almost certainly be unreasonable assumptions. And that's what the reporting accountant has to determine. Are the assumptions which underlie this prospective financial information, are the assumptions which are used, are they reasonable? Again, with hotel occupancies, history, statistics in different locations, obviously, different areas, suggest that 40% occupancy is a general principle. 40% occupancy is what we should be content with. But if you're planning on building a new hotel and you put 40% occupancy in there and the figure comes out as a negative, the overall profit at the end of the first 3 years is going to be zero and we're going to have a 53 million overdraft, and then you change the occupancy rate and you'll increase the rate per room. And so eventually the bottom figure, the bottom right-hand corner of your spreadsheet, moves into positive and the overdraft moves away and we're now a positive bank balance. Yeah, that's good enough. We'll show the bank that. It's so false. But you mustn't let my cynicism rub off onto you. You're pure, innocent, honest people. Don't let my age destroy your honest minds. You're trustworthy, believing that everyone is an honest person. The information, having realized or having discovered what the assumptions are, the information should be properly prepared. So you do the checking. If you're on an Excel spreadsheet, then you check the validity and integrity of the cell formulae to make sure that the cell adequately reflects and properly reflects the assumptions which underpin the projection. Information should be properly presented and all material assumptions adequately disclosed. Then we've got an example here. Oh, there we go. Look at that. We've got some assumptions in there as well. And question E by Gun. Planning a management buyout from their company, their parent. So the directors of the subsidiary are planning a management buyout to take over the subsidiary from the parent. They've asked you to report on the accuracy. Why? Well, they're probably going to ask a bank for funding, but we'll find that out in a minute. Yes, there they are. And they've done a profit forecast and statement of financial position for the following 5 years. They buy car parts from manufacturers and sell them to retailers, mainly on a cash basis, about 20 retail outlets. management is planning to finance it from their own resources and from funds which they're hoping will be provided by financial institutions. And therefore you know that this prospective financial information is going to be presented to these financial institutions with a view to seeking finance. Expected equity shares will be purchased by a financial institution and by their directors. Current loan account between the company and their parent will be repaid and will be replaced by loans from banks and other financial institutions. Some of these loans will have the option of conversion into equity at a later date. Detailed monthly forecast of income statement, and budgeted statements of financial position have been prepared. A detailed monthly forecast, together with an annual forecast of comprehensive income and statement of financial position, prepared for the next 4 years. So we've got 1 year's detailed income statement and financial position, and we have an annual forecast of income and financial position for the next 4 years. What work will you perform on the forecast statements? Now, yet again, I'm going to suggest to you, this is common sense. How do you determine the reliability or reasonableness of a prediction? Well, I know all of you in the room regularly look at your weather forecasts from different sites, and different sites come up with rather differing opinions of where the weather is going to be next week. So how are you going to determine the reliability of these predictions?
To check last year's files, and then
all right, check last year's file.
check what tendencies are in the market.
Check the trends in the market. I would agree with trends in the market. All right, and therefore the historic trend of sales growth, for instance. Has Ibargum in its last year disclosed a 5-year table of their sales growth and product costs and profitability? Yeah, okay, we can do that. When you say last year's file, I think really not last year's audit file. When I say check last year's file, let's check last year's audit file. You may not actually have been the auditor of this, but there will be historical records of the performance of the last 5 years, even though they're not on your files. Another one? Inga?
All the assumptions.
Yeah, get a copy of all the assumptions which have been used in preparing this predicted information, this forecast information. Forecast, not information, forecast results. Another one? Well, I'll give you a clue, or I'll tell you actually. How accurate have these directors of Ibargum been in any forecasts which they have prepared in the previous periods in history? How accurate have they managed to be in predicting results in the past? So maybe get a copy of last year's forecast income statement, last year's forecast balance sheet, and compare it with how well they have done in the most recent set of financial statements. And I can condense that into just 1 or 2 words and say, we need to confirm the reliability of management or the person preparing it. It's not prepared by the company, it's not prepared by the board, it's prepared by an individual. These projections are prepared by an individual. And you really need to consider the competences of that individual. You need to see how well they have predicted in the past. You need to see if they're qualified and competent. You need to see whether there is any motivation for them, obvious motivation for them to manipulate or be creative in the assumptions that they've used and the figures that they're preparing. You could consider the competitors to determine whether the selling price of our car parts is a competitively priced, because if it's not competitively priced, then they're certainly not going to achieve any sales growth that they may be predicting. You need to think about whether all relevant expenses have been included, like depreciation, in a projected income statement, Whereas if it's a projected cash flow, then you would expect to see depreciation not included. You would need to consider whether any receipts of cash or recognition of profit from the sale of tangible non-currents is reasonable according to market prices, and whether the tangible non-current assets which are to be sold are not desperately needed within the company. If they are desperately needed, is the company predicting changing them? And if so, are they changing them by finance lease, operating lease, or by new purchase? If it's new purchase, are the funds available? If it's finance lease, will we be able to service the finance lease? If it's the operating lease, has it been correctly treated as an expense in full rather than just any interest calculated on the operating lease? You need to consider unusual expense stroke cash outflow like tax payments, because tax payments only in the UK, they only occur once a year. And therefore, has the tax been, inverted commas, correctly calculated on the forecast profits, and has the payment been correctly reflected in the right period? You need to think about, are we forecasting any dividend payments? And are we able to service these financial institution and bank loans at current rates of interest, and have we anticipated maybe an increase in interest rates, and will we be able to continue servicing that? Cash projections typically will start at a base point which is already history. And therefore, we need to confirm that the start point of our receivables and payables and cash and inventory, we need to consider whether the start point of the projection is in accordance with the historical fact. And there is likely a period already passed between the start of the cash flow projection and the time that we're approaching the bank. There could very well be a time period, a month maybe, that the projection was already prepared on the basis of historical data, the receivables, payables, inventory, cash levels, and the period is based on that, and then we project for the next year in detail, month by month, and the 4 years after that on an overall annual basis. If there is a time period which has already passed from the start of the projection up to the time we're being involved, then we need to compare actual results with the forecast results for the period which has already gone. We would want to confirm the arithmetical accuracy of the projections. And I suppose sensibly the history of the loyalty of Ibargum's customers continually to return. You'd want to consider the identity of these directors and whether their identity is fundamental to the loyalty of the customers. Because if any one of these directors were to propose leaving, either to retire, in which case his friends may choose to go to a competitor, or alternatively to set up a competing business, in which case his friends will follow him and take their business to his new company. You need to consider those possibilities, because that would have an adverse effect on the achievability of the forecast results. So a number of things, and I'm standing here thinking to myself, it's common sense. I don't think I've said anything there which is desperately clever or intuitive or wonderful and oh gosh, I wish I had Mike's wonderful mind. I don't think I've said anything clever that you couldn't have thought of. It's really trying to stimulate your own thought processes, because you know all of those points that you've written down. You know all of those. It's just a question of would you have thought of them yourself in the exam situation? The answer is of course you would. But there are many thousands of students around the world that won't have thought of them. And each one that you put down is ones that others, hundreds and thousands of people, will not have put down in their answers. Each one of those, I suggest, will be worth a mark. And each mark gets me that one step closer to 50.